Hi, everyone. This is Jason Bierek of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a first-time guest, but I followed his work when he's been interviewed by Jim Poplava on Financial Sense, and also since 2006, he began writing an annual report on gold called In Gold We Trust that's been featured on CNBC, Bloomberg, and also on Zero Hedge. So he's now the managing director at Incrementum Group, and he's also a senior advisor at Ursa Group. It's Ronald Stoeferle. So thank you for joining us here today from Liechtenstein, Ronald Stoeferle.
Hi, many thanks for having me. Thank you.
Now, Ronald, let's talk about your background a little bit first for our listeners who are not familiar with your work. What got you interested in gold?
Junior mining company, exploration company called Osisko. And I bought it very, very early. Didn't have any clue about the mining business, and then it ended up as a 40-bagger and is now one of the biggest producing mines in Canada. And I was back in the days I was working at Erste Group in Vienna, and I was responsible for Asian equities. And I went to my boss and said, I got this gold mining stock, and it's doing very well. So would you allow me to write a short piece on gold? And he said, yeah, go ahead, read into it and write something. And yeah, that was the first In Gold We Trust report in 2006. And within the years, the reports became bigger and longer. So the longest was like 130 pages. I tried to implement the views of the Austrian School of Economics into my models. I tried to establish this holistic view, basically analyzing gold like not like a commodity, but like a currency. And I think that's what kind of differentiates my report from the rest of the gold report. So, yeah, 2 years ago I quitted my job as an analyst and set up a new company together with some partners from Switzerland. And this year we launched our third fund, and yeah, it's quite a ride. I enjoyed it very much.
Yeah, it's been a very interesting last few years for gold. We've had really since 2011, we've had a cyclical bear market. Do you think that cyclical bear market is starting to come to an end now?
Yeah, I think so. I think it's mainly due to the disinflation that we experienced since then. I think that this is a very normal and a healthy correction that we're seeing. We shouldn't forget that gold was up 11 years in a row. We have already experienced in 2011 that every big bank, Citibank, Goldman, JP, they were all extremely bullish on the price of gold, which from a contrarian point is always a bad thing. So I think it's been a tough and a severe correction, but it was a healthy process. And then in my last gold report, I wrote that we are at the very end of this correction process. And I think we are in the early stages of the next phase of the uptrend. And I don't expect for the next few months, I don't expect major momentum upwards. So my next 12-month target is around $1,500. But I think at the current price level, I think gold is a bargain, and especially the mining stocks are a bargain, and they are quite a contrarian trade at the moment.
Yeah, I was talking before we started recording. I think the mining stocks are probably one of the few value investments in the general stock market right now. They're just absolutely hated. Even though they've been one of the top outperformers in 2014, most of the people on Wall Street don't believe it. They're talking about selling the rally and shorting them again. And, we're starting to see these calls from gold stock analysts and also people on charts saying, gold's going to test 1,000 or it's going to go below 1,000 again. But, I don't think that's going to happen for a number of reasons. And I think really the period of the cyclical bear market from 2011 up until, the beginning of 2014. I think that resembles a lot in terms of the past history, the 1974 to 1976 cyclical bear market in gold, which was, within the secular bull market of gold, where gold went a lot higher before Paul Volcker came along and, started defending the dollar. But I really don't see any central bankers right now. I don't know about you, but I don't see any central bankers right now who want to defend their currency, who want to raise their interest rates and defend their own currency and make it strong.
Totally agree. It's basically a race to the bottom, and back here in Europe, for example, we're seeing this major deflation scare. So I think the media did quite well in creating a picture about deflation as the big threat at the moment, and this allows the ECB to implement very inflationary measures. So comparing the current scenario with Paul Volcker back in the days, he wanted to kill inflation, and on the other hand, now central bankers, they want to create inflation. They desperately want to create inflation. So that's a major difference. And I think if you compare the 70s bull market in gold to the current bull market, I think when it comes to the debt situation, in the beginning of the 1980s, we have seen this over-indebtedness for on the state level, but not on a private level, and also not on a company level. What we're experiencing now is that more or less everybody is highly indebted, and that interest rates it's basically impossible that we'll see a significant rise in interest rates. And therefore, I think the Fed is way behind the curve. They will stay behind the curve, and therefore, we stated in the beginning of 2014, we said not deflation will be the major topic going forward. It will be inflation, and inflation is still sort of a contrarian trade as well, because still everybody is scared of deflation. But on the other hand, the market, especially commodity prices, but also the precious metals, they are already indicating that we're seeing rising inflation. So we did quite a lot of quantitative analysis, and it clearly shows that mining equities, oil equities, and commodities in general are most sensitive to changes in inflation. And all those asset classes are up quite significantly since the beginning of the year. And therefore, I think that even though Janet Yellen says that inflation is only noise at the moment, I think this will be a major topic going forward. And there's this brilliant saying from the wonderful book Lords of Finance, and it says monetary policy doesn't work like a scalpel, but like a sledgehammer. And therefore, I think that this current lowflation environment that we're seeing, this will end very, very soon.
Yeah, I mean, what they've done is, they've done financial repression. They're targeting nominal growth rates. They're keeping rates suppressed. Obviously, you study the Austrian school. This is not a free market on interest rates that we have here, because I don't think the bond market is pricing in at all, default risk, inflation risk, or anything like that. I think the market is just pricing in that the front runners can trade the bonds and then sell them to the central banks who are going to buy them all back. So I think that's all they're trying to scalp quick profits there. But in terms of inflation, it's very interesting that you brought that up, because the government statistics say, there is no inflation in many countries. I mean, in the developing world, like in India, I think they had a 7% inflation rate. It's probably at least double that. The U.S., I think official CPI is 2.6%. The MIT Billion Price Project's price, which tracks a lot of online prices, I think they're saying it's about 4%. My personal food bill, my electricity bill, my health care here in the United States, I'd say it's way more than that. And, the statistics are not reflecting this, but I think, like you said, the oil market is reflecting this. The gold and silver markets are starting to wake up and sniff this out. But, I mean, it just seems to me that a lot of the inflation that's been printed from all these central banks, and it's not just the U.S. printing, it's Japan, it's China off dollar pegs. It's been going into the asset markets first for the last, 4 or 5 years since the quantitative easing program started, and that's why, the general stock market in the U.S. is up, the property markets in the U.S. are starting to go back up, and the bond market has stayed higher than many people have, because I know we've had a lot of experts calling for a bond market crash.
Yeah, I totally agree. And I mean, if your personal inflation is too high, perhaps you should buy more iPads or iPhones. No, just kidding. We all know that the official calculation of inflation statistics doesn't resemble real life, and we all know that it's rigged. But you mentioned the Billion Prices project, and there it's quite a leading indicator for CPI numbers and for PCE numbers, and it's already showing a major divergence. So I think, and it is also based on the Austrian School of Economics. First, there's asset price inflation, and we're already massively experiencing it on equity markets, in bond markets, art markets. Of course, I talked to a friend of mine. He is kind of investing into rare red wines, and he said, "Yep, it's the business is going crazy. We're seeing it in real estate." So we're already experiencing this asset price inflation, and normally the next stage will be consumer price inflation, and we're, I think, very close to a tipping point. And as you well know, the geopolitical situation at the moment is extremely fragile, and I honestly fear that one of those
black swans.
Yeah, I think it's something will happen, and that's going to have a major impact on energy prices, of course, and this will lead to higher commodity prices in general. So I think we should not forget that central bankers, they completely misunderstand the dynamics of inflation. They just don't get it, and I've got quite a long chapter on this increasing acceptance of price inflation that we're experiencing at the moment. So many central bankers and chief economists and so on. Okay, we should let inflation rise above our official mandate, above 2 or 3%, but just for a while. But history clearly teaches us neither the mainstream economists nor central bankers have any control over the specific characteristics of inflation dynamics. They just don't get it. So therefore, I think the current monetary experiments that we're seeing are extremely dangerous, and in this scenario, yeah, I think it's quite prudent to be overweighted in gold and mining equities, for example.
Yeah, I completely agree. I think physical precious metals, whether it's gold, silver, maybe a little bit of platinum and palladium too, and then also the mining equities, because there's a lot of value there. And then you also mentioned the oil companies. I think those are good because I consider oil black gold, and unlike gold, oil is actually consumed and it's not recyclable.
Yeah.
And same thing for natural gas.
Yeah.
So I think those are good. Those are good diversification tools for someone who doesn't want to go all in on physical gold, because what I tell my listeners, Ronald, is that the most important rule is that the politicians can change the rules anytime they want. So to go all in on any single one thing or asset class is kind of dangerous in this environment, because, in terms of Europe, some European countries like France already have very strict rules, right, about gold purchases and silver purchases, right? Don't people have to register? Or I think in England there's a very high VAT tax on metal, on buying metal already, right?
Yeah, there's lots of things that might happen, and I think sort of a geographical diversification makes sense, because unfortunately financial repression will be we will see that increasingly. And I don't know if you followed it, but quite recently Spain said that there will be a charge on bank deposits. It's only 0.003%, but still they implemented it since the beginning of 2014. So there are a lot of things. Pardon?
I call that the Keynesian Endgame because the Keynesians are just
Yeah.
running out of schemes to try to take assets away from people and redistribute wealth and create inflation. And they've gone to what the Keynesian theory is that when nothing else works, we go to negative interest rates, right, to get people to spend.
Totally. But it's if you understand and read the Austrian School of Economics, you will come to the conclusion that it's just nonsense. And unfortunately, at the moment, for investors, it's very important to anticipate the steps the next steps of central bankers and politicians, and this clearly shows you that it's not a healthy market. So we have to expect that financial repression as well as wealth taxes in various forms will increasingly gain in importance in coming years, and I think that physical gold stored outside of the banking system is quite a good hedge in such a scenario. But there is unfortunately not the perfect investment. I think it's just sensible to diversify, not only in terms of asset classes, but also in terms of regions, geographical regions. And I think it's not time to be greedy and to try to make as much money as possible. I think it's time to
play defense.
Yeah, exactly. Yeah, and there's this old saying in football. I think it's isn't it offense wins games, but defense wins championships.
Yep.
Yeah.
It's like that in many sports. Yep.
Yeah, I totally agree to that, and I think that's the perfect strategy in this current setup.
Now, you live in Europe. You've lived in Europe for a while. What's European sentiment towards gold right now?
I think one has to differentiate because I'm originally from Austria, and also Germany and Switzerland are very keen when it comes to gold, and gold is just a normal part of your portfolio. Talking to people from Italy, for example, from Spain, from UK, it's completely different. They don't have any history in investing in gold. When I talk to the generation of my grandparents, for example, they lived through two currency reforms. They lived through hyperinflation. They lived through world wars. So for them, it's only normal to have physical gold, physical silver. And I think in my generation, it is something that is clearly coming back again. Gold is something, from my point of view, very conservative and even very, very boring. And I think this attitude is coming back. However, in the short term, I think that people have kind of lost interest in gold. They also lost trust in gold because, gold was down roughly 30% in 2013. So people kept saying, okay, so this is the monetary insurance asset that is going down 30% in 1 year. And therefore, I think that the current sentiment as a contrarian, it makes me extremely confident because the mainstream is not buying gold at the moment. But in general, I would say that gold plays a very significant role for German-speaking countries in Europe.
Yeah, and to add to your point about the contrarian sentiment, here in the U.S., the major New York Hard Asset Conference and San Francisco Hard Asset Conference, these were popular conferences during the gold and silver bull markets. These were just canceled.
Really?
So I think that, yes, I just found that out this week. So I think that's a good contrarian indicator going forward that, Wall Street doesn't really believe it. Or most of the people on Wall Street don't believe it, although some of my sources on Wall Street, I interviewed Charles Ortel yesterday. He told me that, and he's a well-connected value investor that's worked a lot on Wall Street, he said a lot of people on Wall Street are bashing gold and silver in public still, but a lot of them are buying as much physical metal as they can in private. because they have a fund to sell, they have a paper fund to sell with stocks or bonds or something like that, but they really believe that the central bankers, are putting things together with glue and duct tape, and they don't really know what they're doing. They're conducting this live science experiment that they're pretty much clueless about how it's going to turn out.
Yeah, I think that's something that I'm experiencing, having meeting with institutional clients as well. It's I think talking about gold, many clients they kind of ridicule you, but talking about gold mining equities, they really start laughing hard, because that's that's not in favor at the moment. But those type of people, they are normally not able to be contrarian investors because of of their structures in their companies and so on. So they always buy past performance. And the fact that they're not invested at all with the companies at the moment, I think that's a good sign. Having a look at the forecasts by the big banks, I think that's also a very good sign, because most of them say that gold will go to basically flat or down in this year and next year again. So that's a very good sign. And I think all those wealth managers, private bankers, and so on, they will start buying gold again at 1,500, at 1,600, because they need to buy past performance. They cannot act as a contrarian player.
Now, let's talk about some of the supply-demand fundamentals for gold. You've also visited some Swiss refiners. So what are the Swiss refiners saying about their ability to source supply of gold to melt it down, I guess, into kilogram bars?
Yeah, that they're saying that there's the supply is mainly coming from Western countries. It's quite often those are very old bars, and most of those kilo bars are going to the east, and I think that's a very big trend. This shift from the Western world to the Eastern world. We're seeing this steady migration of gold. And it continues. And I mean, by now, China and India, they account for more than 60% of the physical demand. And I think that there's a very nice comparison. And I always try to find historical comparisons. And gold always moves from those countries in which capital is consumed to those countries where capital is accumulated. And we have already seen that when the Romans they noticed this 2,000 years ago, when the Chinese and the Indians would only accept gold in exchange for spices and silk instead of Roman goods, and therefore I think that it's very likely that gold is increasingly being hoarded in Asia, and that its circulation is kind of declining as it's increasingly held in strong hands. So I think this is a very, very interesting trend that is continuing, and I think one also has to differentiate between this so-called fear trade and the love trade. And I think the love trade is a major long-term trend. It's intact. It's based on rising incomes, on high saving deposits, urbanization and transformation from an agrarian society into an industrial nation, inflation fears and so on in the emerging markets. And then we've got this fear trade, mostly by Western market participants, buying gold because of fear of high inflation, currency reforms, financial repression, and so on. And I think this fear trade calmed down a bit, but I expect it to gain in importance going forward, because even though many people, professional players nowadays say that the crisis is over, everybody kind of has the gut feeling that we are far away from an end of this crisis, and that we've only bought time, and that the next crisis will probably be more severe than in 2008. And that the interesting fact will be the Fed, but also the countries, they will be running out of bullets, because in 2008 they were able to lower interest rates, they were able to introduce quantitative easing, what will they do now? Will they implement QE with, I don't know, 200 or 300 billion per month? They're not able to lower interest rates anymore. Will the nations be able to implement major stimulus packages? I highly doubt it. So it's really gonna be interesting what's gonna happen. And my thesis is also based on Jim Rickards, who is an advisor to our fund. He says that that the IMF will play a bigger role in the next crisis, and that some sort of special drawing rights will be the next stage, and they will try to implement a global reserve currency.
Yeah, and it's not going to be backed by any. I'm very familiar with Jim Rickards' work, having read Currency Wars and also his newest book, The Death of Money. And I've also interviewed him too in the past. In terms of the banks and the governments, I don't think any problems with the crisis have been solved, really. I just think the governments have taken on a lot of the debt and other obligations. They've printed currency, created it out of nothing, and they've taken these bad assets off the banks. And in the U.S., like these too big to fail banks, they've gotten even bigger. And that's because of the Federal Reserve, allowing the banks, bailing them out, protecting the large banks. And, in a free market, these banks would have never gotten that big to begin with. They just wouldn't have. There's no way that they would have gotten this big to begin with, because the insurance companies would have prevented them. They wouldn't have insured them, and there would have been people there that would have looked at their balance sheet with their accounting and said, I'm not going to keep my money at this bank. And there would have been all these other protective measures put in place preventing the banks from getting this big. But instead, you have the Federal Reserve and other, cartels, which are central banks, and allowing, the governments to spend unlimited amounts of money and the banks to keep growing much larger than they would have in a free market. And I think, it's a very valid point that you brought up is, how is this thing, what's the next system going to be? Because the current system we have is it's not sustainable. And I think there's just so many people that have come out, Paul Volcker, so many other people that have come out and said, this system is not sustainable. The system is a zombie system. And, the question is, what's the next system going to be?
That's a very good question. Unfortunately, I don't have an exact answer, but I think that some sort of a Japanese scenario is quite likely for the Western world. It would probably be some sort of a best case scenario. And what we're experiencing in Japan nowadays, we also call it the Keynesian Endgame, because it's a final and desperate attempt to keep a debt dynamic going that must sooner or later collapse, and they're basically in the corner, and they will not come out of this corner. But I think that Japan might be some sort of a harbinger of what the West will soon face as well. But a painless way out of this situation is unthinkable. But we will continue to muddle through. I think that the central bankers are kind of searching for the monetary perpetuum mobile. In the 19th century, the laws of thermodynamics provided the foundation for the understanding that it is impossible to create energy out of nothing. And at the moment, still central banks and governments are trying to create and increase prosperity out of nothing. And we all know that this would be desirable, but history clearly shows that it just doesn't work. And therefore, I honestly think that the current system will survive much longer than many people would expect, because there are so many people and parties interested in the system surviving a bit longer. But I think as the longer it exists, the more severe the crisis and the reset will be. And I don't want to sound like a doomsday sayer, but we have to be realistic and say, okay, we're in big trouble, and the longer we continue, the bigger the trouble will be. And therefore, I think it's only prudent to buy insurance for such a scenario, and not only from an investing point of view. I think it's also quite advisable to mentally prepare for a major crisis. And I think that 99% of the people got no clue what's currently going on and what the threats are. And if you have 1% of the people who kind of know what might happen, then you got a huge advantage.
Yeah, I would agree. And I worked at a very large investing newsletter company in the United States called Investing Daily. 5 million a year in sales for newsletter, over 5 million a year in sales for newsletters, for dividend stocks, basic things like that. And there was a lot of analysts there with a decade or two of experience. These were bottom up fundamental value analysts. Went to good schools, business schools, and things like that. They have no clue about the derivatives market, Ronald, or any of these other things that you and I would know about. They haven't read Jim Rickards' books. They don't even know who Jim Rickards is. So they're trusting the people in power way too much, unfortunately. But yeah, we've gotten to the basic Keynesian endgame, like you said. I think where Japan is looking like maybe a best case scenario, and the problem with Keynesian economics is you can't consume and spend your way to prosperity. So, as a family, this, that you cannot, if you don't have the income, you can't continually keep running up your credit card when you don't have the income to match the debt bill. And Keynesian economics, just seems to not really care about that. The currency system is debt-based. It's growing basically an exponential function in terms of the base money supply over a long-term chart. Chris Martinson's work has done this. And I think gold is really the safest insurance plan right now that people can have. In terms of the miners, though, do you think the miners are going to be able to survive dealing with production costs and some of these rule changes from politicians?
Yeah, I think so. I mean, just one number about the undervaluation of mining stocks. Gold stocks relative to gold are at the lowest level in more than 70 years. In my last report, I made a chart with the BGMI, that's the Barron's Gold Mining Index, compared to the price of gold, and it's at the lowest level since for 70 years. So that clearly shows you how disgusted the market is with mining stocks. I think that we are seeing what Schumpeter would call creative destruction within the sector. I mean, gold stocks, they clearly fail to deliver the expected leverage, and many investors are just frustrated and disgusted by their performance. But we have seen quite recently that there's lots of positive things happening. We have seen that a lot of CEOs were replaced. We have seen increasingly higher cost discipline. So, for example, the all-in costs, they actually fell compared to 2012 in the fourth quarter of 2013. We are seeing cost transparency. We are seeing that a number of exploration and development projects were sold or put on hold. We're seeing focus on higher return ounces. Balance sheets were strengthened. So I think it's a very, very good opportunity to buy into a sector that is hated by the market, but that clearly shows that there's also lots of positive things happening. And as we have seen those massive write-downs and those charges that were one-off measures, I think that at the moment we are seeing even a higher beta and higher leverage in the mining stocks, and therefore I think that we are seeing a highly asymmetrical risk-reward ratio for the mining stocks. But I think it's important to say and to mention that we regard gold as a currency, and thus, from my point of view, gold ownership is a form of saving, while gold stocks are an investment. I think those are two different things, and I think both are interesting at the moment. But you should never compare gold mining stocks with physical bullion. I think that's a very important point to make.
Yeah, unless the miners, Ronald, start paying dividends, maybe as the inflation worsens. I know I've heard a couple of gold and silver miners talk about this because I spoke with the investor relation department of this. And there's already one gold mining company, Goro, that pays a dividend in bullion. But maybe as the inflation worsens, we're going to see the miners consider, I'm sure a number of them have already discussed this, but start to pay dividends in bullion if their shareholders demand it enough.
Yeah, I think it's perhaps from an administrational point of view, it's a bit difficult. But we're seeing a number of projects at the moment linking the dividends to the price of gold. And I think, as I've said, there's really a lot of positive things happening in the mining sector at the moment, but the market doesn't really appreciate it, and that's a big opportunity for investors.
Yeah, I completely agree. In wrapping things up, Ronald, please tell our listeners more about your report and where they can find it, and also your fund.
The report, you can download it on incrementum.li. Jason, I can also provide it for you for your webpage for the download section. Just Google "In Gold We Trust 2014" and you will find it all over the internet. Unfortunately, our fund is not investable for U.S. investors. I'm sorry about that, but that's the legal framework, unfortunately, nowadays.
We have European listeners. We do have European listeners, though, so maybe
that's good. Very good. Very good. What we are doing, we are focusing on inflation-sensitive assets. Meaning mining stocks, oil equities, and commodities in general. But from our point of view, it's important to time them. So I don't think it's that they're a buy and hold investment class. So we have created our own inflation signal. It's not a government statistic or anything like that. We're getting our inflation numbers from the market, and we built an inflation signal out of it that works very, very well. And based on the inflation trend, we're investing in inflation-sensitive assets. And this whole fund is, as I am not only from Austria, but as I also adhere very much to the Austrian School of Economics, the Austrian school plays a major role in our investment process.
Very good. And enjoyed my conversation. I learned quite a bit about the gold market from you, and thanks again for your time.
Thanks a lot. All the best for you and your listeners. And thanks for the invitation. Take care.